the case. So today's session will be recorded. That means, unfortunately, I won't be able to unmute the lines. All of you shall remain static. If you have questions, please submit the questions in the question pane. All right. Again, my name is Damon Richardson. I am the renovation specialist here at REMN. And today's presentation is called Renovation Investments in You, because yes, you can help investors, and oh yes, you absolutely should, because 2018 is going to be quite a different year than the years past. We will need to do some things in order to generate business and keep the year profitable for all of us, because that's how we stay with our doors open. Now, let's something straight from the very beginning. When you're doing investor loans as a renovation, we're only talking about one loan program, all right? The 203K is not going to be useful here, because the 203K is strictly for the use of owner occupants. So if you're purchasing as an investor or refinancing as an investor, obviously owner occupied, you are not. So let's make sure that we're always talking in terms of the conventional Fannie Mae HomeStyle, which means we have to put ourselves in only the Fannie Mae HomeStyle style of mind, all right? So, and we're not even going to talk about owner-occupied LTVs or anything else like that. We are going to keep this focus strictly on speaking about the investment side, all right? So, the number one limitation with using this program as an investor is going to be Fannie Mae limits investors to single family homes, all right? No multifamily investors. It's not an overlay on our part. This is coming directly from Fannie Mae. So there's nothing that we can do about that. We also have to talk about LTVs, all right? Maximum purchase LTV that we can accommodate on a HomeStyle loan is going to be at 85%, but this 85% is beautiful because it does two different things as opposed to just one. We're talking about the simultaneous financing of the purchase price of the property, but also the money going toward the renovations that will take place on the subject property after closing. If we are looking at refinances, and refinances are going to be a definite must in many cases, let us talk about that LTV limitation, 75%. And again, this is 75% that is going to be based off of your purchase price, as well as 75% of the renovation cost of the work being done to the subject property. All right, so that's what we have going on inside of the program. But let's talk about why on earth you should consider doing this. What's in it for you as the loan officer? Right, the benefits to you are plain and simple. A, direct originations. By increasing your market of people that you can represent for home mortgages, you get to write more loans. If you get to write more loans, that means that you get to close more loans and make more money. That is the name of the game. So how are we going to do that? A, let's deepen your relationships with your real estate agents, people that refer the vast majority of your purchase business. All right, let's make those relationships deeper. Let's talk about the needs of those agents and how you are going to fill them. And that first, the first little caveat in this is to talk about the other side of their business, the side that you don't get to touch. Every single agent obviously is helping people find homes, and they are getting them financed. And that's exactly what you've accustomed yourself to dealing with agents. They have an entire other side of their business where they're dealing with property owners and listing properties for sale, which you don't touch. And then they are also working with a handful of investors, helping them determine eligibility for decent properties that represent a chance for profitability, helping them not only find which properties make good candidates, but also in the acquisition of those properties. And then lastly, they are then relisting those properties for the investor so the sale can be completed, which then for the investor ends their cycle in the scale of profitability. Acquire the property, renovate the property, sell the property, receive receive the actual revenue, and then ultimately the profit is what this was all about, in the end run. you can insert yourself right in the middle of that particular process, in that particular process. And by doing so, you are going to help strengthen the core elements of it by making sure that the quality of work that's done to the subject property by the investor can be, so the bar for quality can be increased, which will then also increase the actual resale value of the properties, which gives your which gives your real estate agent a much more profitable scenario in terms of relisting this particular property. If they can relist it with all the work done well, it will sell at a premium price. If corners were cut during the renovations, the resale showings don't go as well. They're not as successful. They're not able to make as much of an actual profit for the investor, and everything is kind of strained. And right now, investors are absolutely accustomed to this particular cycle because of the financial necessities that are in play. There's only a finite amount of money that each investor has to work with. This is also going to help. In talking about the properties that the agents represent for property sellers, ultimately, many of these agents are left with stubborn property sellers that are demanding top market prices for their properties that haven't been updated in 10, 15, 20 years. Sellers that are not willing to invest any more money into the property, but are still holding out hope that someone is going to offer them the actual maximum price available for their market, which obviously their property doesn't hold up. So it's not going to happen. And those properties sit, the seller blames the agent, the listing eventually expires, and this person either relists as a FSBO, finds a new agent, and starts the entire process all over again. By offering your real estate agents the ability to talk to these sellers about being able to use the HomeStyle as an investor vehicle to then refinance the property, factor in the cost of making a modest renovation to bring the property up to market standards, and then be able to immediately relist the property because it was financed as an investor is a key advantage, which would then allow the agents to come up with the solution to get top dollar for the property, without having to make a significant out-of-pocket expense as an investment into the property, and then ultimately be able to resell with confidence. That is something that is key. That is how you become a person of value to your real estate agent, because now you are helping them with the other side of their business. You are helping them find profitability on a whole different plane than just the standard meets the eye one-to-one relationship that you've always had with your real estate agents. This is going to deepen it to the other side, which is amazing. And let's talk about contractors while we're on the subject of deepening relationships. Right now, if you're doing renovation for your owner-occupied borrowers, you are coming across a network of contractors, people that you're working with, and they are taking jobs for you. You should be asking them if they have leads for you. And those leads, simply put, hey, have you come across anyone that has started the bidding process for a project, but since the project has cost, the design of the project cost so much more than they were anticipating, they've backed out? By default, you should be asking that question, because each and every single one of those scenarios turns into a mortgage application for you. But how do you increase your opportunity to have that conversation? Simply put, if you have already worked with them, if you've already had them vetted and approved through our process, recommend these very same contractors to the real estate agents when they're talking to their investors or when they're talking to homeowners that need to do quick renovations. By all intents and purposes, this is another opportunity to A, get that contractor more business, but then B, it gives you plenty of justification to ask about other potential homeowners that could use your services to help afford renovation projects. Right, so this is something that is definitely a very interesting benefit and a multitude of levels that really do help generate more referrals from your existing referral sources. In a year like 2018, where lead sources and everything else are going to become so vitally important, being able to cultivate existing relationships with zero additional cost is going to be the most profitable and cost-effective way to drive new business. Right? It is going to be absolutely paramount for you to find ways to be more effective in these particular measures, because everyone needs to find a way to make more. I'm only suggesting that you find a way to make more by spending less. All right, so that is hugely, hugely, hugely important. So let's talk about the actual dollars and cents, the finances of the situation, and how everything actually works. All right, because this, by far, is the reason why we're all here. In fact, wait a minute, I think we've missed something. No, we have not. All right, this is the reason why we're here. We have to understand the numbers. So, why does this benefit the investors? And the simple answer is because of the math, and the math is very, very, very simple. In fact, I've laid it out here in two distinct columns. Two things that you need to see as to how this winds up, or how this lines up exactly. And we're just going to go through a scenario. An investor purchasing a property at $150,000. All right, it's actually a pretty sweetheart deal. The property has a current as-is value that the investor is estimating to be at $225,000. So it's already going to be worth it. With a $50,000 investment, he expects that he would be able to fetch a price maybe as high as $300,000, based on the market and the way everything looks right now, for a turnkey listing. So he's going to make his investment. Underneath the normal model, he's going to purchase the property at $150,000. He may do this from his own capital reserves. All right, he may buy the property cash. However, there's a distinct possibility that he's going to wind up using a private investor to help offset the cost. These private investors will actually work with will work with the actual property investor to finance the property at 75%, maybe even 80% some of the time. They're going to wind up getting a mortgage, and that mortgage is going to be in the amount of about $112,000. That mortgage is going to be at an exorbitantly high interest rate. The very best, if they have a very, very strong relationship with the investor, it's going to be at about a 9% rate. If they do not have an extraordinarily strong relationship with the investor, they're going to be over 10%, more than likely in a range between 11 and 13%. But the mortgage is going to be arranged in a way that is interest only. All right? They're going to find a way to actually give them extraordinarily low payments for at least 8 or 9 months. That 8 or 9 months of ownership is going to be their window for performing the renovations of the property and initiating the sales process. But make no mistake about it, they're not going to be able to afford when the loan goes into its fully amortized state. All the advantages of being able to procure financing quickly and then to have a very low payment during that first interim period, that's great. But they have a definite hard out. They need it to be done before the fully amortized payments start, because the financial burden of that payment is going to be a near backbreaker for the investor. Overall, in this particular scenario, their down payment on the purchase, their down payment for the purchase price is $38,700. They're going to wind up with a $50,000 renovation, going out of pocket for about $88,700 in total. All of this money has to come from their cash reserves. If they are in a situation where the cash reserve is running a little bit light, they may have to backtrack on some of the renovations and cut corners, which is going to reduce the overall quality of the finished product, which will have a definite impact on their ability to make profit from this particular situation. All right, cash on hand. For a flipper, cash on hand is the single most important aspect of their business. Cash in hand is what determines how many assets they can acquire. Cash in hand is what determines how extensive of a renovation they can make on any one or all of those assets. Depending upon the quality of the work done to the asset, that is exactly what determines its resale value and whether or not you have a profitable flip or a disastrously bad flip where you just barely broke even, or worse, lost money, which is a very, very difficult thing to deal with. Let's talk about the other side of this, and let's go home style, and let's discuss the difference and how everything works once we make that particular change. to the purchase price of the property. It doesn't change. It's still $150,000. Right, so that is our purchase price. All right, the renovations is planned, still $50,000. That hasn't changed at all. The base purchase price, well, the base down payment, based off of solely the purchase price alone, still would be $38,700 if we're financing at 75%. That will remain exactly the same. However, at 75%, our loan amount would not be the same $112,000. It's actually going to be $37,500 higher. It's going to be at $150,000, which is going to lower the out-of-pocket cost to the investor by $37,500. Their out-of-pocket expense in total is going to be $50,000. That is a very large difference. That's a very large swing. Their out-of-pocket expense from their capital accounts is going to be reduced by $37,500. If you look back at what the base down payment was on the purchase price, this is only $1,000 off of that number. This represents nearly the ability to purchase an entire new asset in the money saved. The addition of one new asset per year for a flipper is the ability to bring in tens of thousands of dollars of additional revenue per year. And that's if they only add on one new property per year. By using this model, if they're incorporated, they will be able to add on several new pieces per year, which raises the profitability of their business dramatically. When it comes down to it, the math is the reason for the season. Just to steal from Christmas a little bit, the math justifies what we're doing because we are helping them reduce their capital expense. And I know what you're probably thinking. Well, there's got to be some kind of detraction. There's got to be some kind of negative that goes on with this. Nothing can be all positive, right? Well, they are going to have to be subjected to using a bank, which is going to be, you, and then we will be your wholesaler after that if you choose to give us your business. And there are several reasons why you should definitely choose to do that. But let's talk about the actual investor and the benefits that they see right off of the bat. And this is what winds up becoming so important. We spoke about what they are likely facing from the investor. All right, when they are tied to the investor, they have very heavy fees and penalties to incur for the speed and access and use of that money. Right, that's just a given. There's nothing we can do about that. By curtailing that relationship, by not using the investor, we're going to give them access to the banking system. Our loan is going to have very moderate fees in comparison to what the investor is used to incurring for procuring financing. It's going to be a lot more friendly, which is going to eat into their profitability margin on each particular purchase or each particular asset much, much less, which just saves them money. And the more money they can save from their capital account, the happier they will be with how their business is going to run. The interest rate on the mortgage, hey, they're accustomed to taking 11, 12, and 13%. I'm sorry, we're going to cap out at 6. You're going to have to offer them a rate that's literally almost half of what they're expecting to pay, which for them is great because it adds another dimension, another ability to their business. All right, inside of that appraisal, it's going to include our good old-fashioned friend, a market rent analysis, which means that they're going to know on the appraisal right up front what market rent for this property would be prior to even completing it. So with a very low interest rate and a human mortgage payment that's fully amortized, they will have the ability to determine whether or not it's more beneficial to hold the property and collect rent for a year or two prior to selling it. You could be in a situation where you are early into the redevelopment of a particular market. And while you stand to make a small profit now, that profit could be substantially greater in a year or so when other developments inside of the area begin to finish, especially if there are commercial retail developments that are also in the works. This gives them the ability to buy, renovate, and hold, and to also generate revenue by holding rent for the property in the interim while they're waiting for the bigger payoff. Okay, this is called financial dexterity, and adding some to the investor is definitely something that they will not forget. It will creates a guaranteed repeat customer. Inside of the world of the renovation themselves, if you are a flipper working with 2 or 3 properties at a time, life is complicated. It's a lot of job sites, it's a lot of responsibility, a lot of people that you have to talk to every day just to make sure things are moving forward at a pace where you will finish and be able to make your profit. With renovation loans, all the project management needed to successfully run the project is already included. They're not paying another person to be their project manager. They're actually getting that information all completely tied into the loan by default. Paying contractors, not something you have to worry about. Property inspections, included in the cost. This is something that is going to be totally managed, which gives them the ability to kind of just have at least one asset that can move along without them needing to actually drop everything and pay attention to it on a near constant basis. So we've got into saving money and an easier process, both financially and physically, which is a very, very, very big deal. And then the biggest benefit of them all, the one that we've waited to talk about. We've mentioned the appraisal here or there, but let's talk about the power of this appraisal, especially for an investor. HomeStyle appraisals are always done subject to the renovation, which means we're not doing them at the property's current as-is value. We are looking at the property's value once all of the renovations are complete. Okay, so that's our after improved value. What this literally means is that the investor gets to start the entire scenario at the very beginning for a $600 investment in an appraisal to find out their resale cost. If this is going to be a bad flip where it will not be profitable, $600 is all it takes to find out. Not thousands of your dollars. Especially not $40,000 from your capital account, not the investment of 5 or 6 months of work into the property only to be disappointed. You will know at the onset whether or not a property is worthwhile of the investment. That will make your real estate agent and yourself look like geniuses every single time it detects a bad flip. It'll also make you look like a like a bona fide truffle pig as you are showing them their road to profitability from the very beginning. It is an absolutely fantastic premise, one that definitely will allow you to broaden your horizons in terms of the type of customers that you are working with, but most importantly, it will help you deepen and strengthen the relationship with referral partners that you currently work with right now. So for all of those reasons, this process and this product is absolutely positively perfect for being able to help you create more with what you already have, because you're going to discover deeper relationships and deeper benefits to existing relationships as they exist. Now, considering how explosive this particular conversation was going to be, I didn't want to plan a long presentation because I really felt that your questions were going to be very, very, very important. So I'm going to literally go back now to start looking through some of the questions that were submitted on the question pane, because I really, really do feel that there's going to be a lot of questions today, and I wanted to make sure that we had a significant amount of time to take advantage of answering those particular questions. All right, so my favorite question, always one of the first ones to pop up in here, and that question clearly is whether or not we recorded the session and will it be made available. Yes, it will. My marketing department does make sure that we get all of the recorded sessions onto our YouTube channel, and as well, we like to send out a copy of the slide deck presentation to everyone that was actually in the audience, so you all will definitely have a chance at having that over the next couple of days. All right. So that's always one of the first questions. I want to make sure that it's that's absolutely answered. All right. Now, Michael Velez, you've asked a really great question. Is the investor allowed to be their own contractor? The answer to that question, flat out, is no. We always have an issue with owner contractors, and that issue is they tend to just kind of do what they want when they want without telling us first. So we definitely want the contractor to use a third-party contractor who will take this as a serious job on their own right, but most importantly, understands how to follow the rules. That will not just assume that it's my house and my rules and just kind of change things as they see fit, but will run them past us first. All right, that remains to be of huge importance. Don't forget, this is still a Fannie Mae HomeStyle loan where we have represented to Fannie Mae what the final condition of the property will be. So we absolutely positively need to know that the contractor is going to live up to the agreement and perform as expected. Now, the great news is, since this is a Fannie Mae HomeStyle, the contractor is allowed to be a relative of the investor. So they can use someone that is a brother or a cousin or an uncle. Any familiar relationship is going to be fine because it doesn't create a conflict of interest inside of a HomeStyle loan. However, that contractor is not allowed to have any ownership interest in the subject property, nor should the actual borrower, the original investor. They should not have an ownership interest in that contracting business either. All right, so those are two very important caveats to that particular piece of information. All right, John Murrins, thank you for this particular question. I knew this is one that was going to come up very soon during this process, and that is, what's going to happen in terms of early payoff? Let's make the situation very clear. When we're talking about doing an investor program, we understand what investors are here to do. Investors are here to purchase the property, renovate it, prepare it for resale. REMN Wholesale has zero intention or plans to require your investors to hold these properties for any given period of time after the purchase. What we want them to do is hold the property until the work is complete. All right, that's when we can complete the case and finish our sale with Fannie Mae. All right, so once we are done with the actual project and we've logged all the completions and everything is done, and we can log it being complete to Fannie Mae, your investor is going to be free to sell the property at will. All right, that's going to be their choice. We will not be standing in the way of this. All right. However, I want you to realize, to a certain degree, we do account for the payoffs in the pricing. All right, the pricing on these loans is not necessarily designed to be pretty. All right, it is definitely not. However, as you are working with us, you want to make sure that you are at least doing some originations of owner-occupied borrowers as well to make sure that we have something to hold on the books for you. All right, we don't want to see a bunch of loans that are all destined to only be on our books for 5 to 6 months. All right, so you definitely want to have something to offset it. But speak to your account executive and our executive management, and we will certainly be able to come to terms with at least an arrangement of how much business that you need to have with us to make sure that you don't have a completely and totally negative pipeline. All right, so that was a fantastic question, John. All right, the next question actually does tie into the early payoff, and this one is not from John, but this is actually from Michael, where he picked up on the idea that, hey, if we are working with a current homeowner that wants to sell the property, if we do an investor HomeStyle, they would be able to relist the property immediately? And the answer is absolutely. If it's financed as an investor, yes, we understand the intention. Again, we know that every investor has one purpose only, that's resale. So we are fully and totally aware of that possibility, and we've planned for it with the pricing. All right, so that is absolutely the case. All right, now let's see our next question. What is early payoff policy for renovation loans? And Kevin, I can see that the absolute possibility for early payoff is definitely the thing on everyone's mind. All right, it definitely is. When it comes down to this particular loan, the investor piece of it, we absolutely positively do understand that this is the one loan that we fund that has the highest incidence of early payoff, because it has it by design. It's for investors, people that are absolutely positively planning to resell the property. So with that being the case, we do understand it. All right, I'll say this one more time. We do understand that. You on your end, you shouldn't have to worry about the early payoff, but we don't want to see only this one type of loan coming in from you. All right, we definitely want to make sure that you have enough business with us to kind of offset the losses that we're incurring on these in particular. All right, so let's make sure that you are working out that relationship. And I would say that you definitely want to speak to your account executive so that we can come to an understanding of how these things will work together. All right, let's see. Our next question is from Carla. If we do a loan for an investor and turn around and sell the house before they make 6 payments or have the loan for 6 months, we'll have to pay back the comp. That is essentially the same question, Carla. You're going to definitely want to work with us so that we can have a good understanding of your concentration of investor loans and how many that we expect to pay off early, which is virtually 100% of the investors. It's just a matter of making sure that we have enough positive business with you to kind of wash that out. All right, let's see. Our next question from Keith, roughly the same thing, roughly the same. So I'm not going to continue to repeat and reiterate the same information about the early payoff, but I think you guys kind of get it by now. All right. Now, the example that I used inside of the slide presentation, and our next question has to do with the LTVs, they've astutely noticed that I did the actual example based on 75% LTV. That's our most successful LTV at the moment because of pricing. All right. I re-looked into this week, early in the week before the actual snow hit here in Jersey, and it looks like we've had a little bit more success with maybe being able to make 85% work in certain scenarios. All right, but 85% because of pricing tends to be a little bit tricky, so I always kind of fall back to the 75% because I know it always works. All right, in situations where the 85% works, it is an even bigger savings. So let's bring up a calculator. Wherever my calculator has gone. Calculator, where are you? Let's bring up a calculator. All right, so now, with said calculator, if we had that very same example, which was a $200,000 investment, if we did this at 85% LTV, the loan amount would be at 170, which would give that very same investor, and if we go back to that particular slide, that would give that very same investor an out-of-pocket expense of only $30,000, which would mean that this would have saved him over the baseline scenario $57,000. I didn't want to lead with those particular numbers because I wanted to be a little bit more realistic. But in scenarios where you can make that work, this is beyond the dream scenario for an investor, beyond the dream. All right, so again, with the use of the product and use of the programs, it's absolutely fantastic. All right, let's see. Our next question is from Rose. She's just double checking. Is the program only available for single family? As an investor, yes. All right, investors are limited to single family. If we were talking about owner occupied, we'd be able to have different LTVs for 1 through 4 units. But today we are only talking about investors. This is for limiting this to investors only. Yes, the limitations on single family properties. All right, so that is hugely, hugely, hugely important. All right, Tim is saying that there is an issue with my math really quickly. So I'm very curious. And since we have a calculator right in front of us, let's do a double check on our scenario. Let's see. Where was he saying? 38,700. 38,700 is the number that's here twice. Well, let's just do a quick 150,000, which is our loan amount. And we're going to subtract that from 112,000, which is what they were going to get from the other, and it's 37,500. That's the difference in out-of-pocket cost, Tim. The math kind of speaks for itself. And overall, as you're looking at this, what you're really comparing is the amount that you're able to finance for both. That is the true difference. On one scenario, you're able to finance $112,000. The other scenario, you're able to finance $150,000. The difference between $112,000 and $150,000 is the actual difference. All right, and that difference is $37,500. see, we have a question from Ken Stouts, but it looks like I only have half of the question. So I'm not sure, Ken, how to answer your question since I only see greater than 6 months between fundings. All right, and if the question is about the EPO, the only requirement that we have is that the work must be finished on the property. That is the only requirement that we're giving your particular borrowers. All right, Sham has a question. Does HomeStyle loan have a restriction on the property being purchased at auction? Actually, it does not. And in fact, for investors that want to purchase properties at auction, we have a distinct advantage that you can use, which is our Tbd Underwriting Policy. Our Tbd Underwriting Policy actually gives your investor a full loan commitment without an address that they can bring to the auction to use to tender on their offer on any particular property. All right, so we would actually have them completely and totally, qualified for a mortgage based on the total amount that they wanted to spend, including the renovation. So let's say that particular investor has a blanket approval from us for $250,000. He goes into the auction and he's able to procure a property for $95,000. He could then show the commitment showing that he has the approval for up to $250,000. Obviously, he doesn't need as much. And then we would be able to then add the property address and then give him a final commitment within 24 hours, which is a beautiful, beautiful, beautiful thing. So he'd be able to, so as long as he was actually able to complete the purchase with time to procure the full financing, that would absolutely work. All right, if it's one of those scenarios or one of those private auction sites where they require payment the day of the auction, that's a little bit of a different story. All right, but the ability to go with the TBD does give your investor the opportunity to walk in kind of with a same as cash, feel. Also, Fannie Mae does not have an issue with properties being purchased at auction, so you definitely have an advantage for yourself there. Let's see, our next question. If the investor has financed 10 properties, can he still do the repairs to one unit? All right, now we do have to talk about the limitation on the number of properties that can be owned by the borrower. All right, so Fannie Mae has an in general limitation that we interpret to be at 4 properties. Overall, even in situations where that can be lifted, we still have a cap of 4 properties plus the subject. All right, now the way to work around this is if your investor is incorporated. All right, if the actual properties are being spread around the members of the corporation and no one is over 4, then whoever is under 4, including the subject property, will be able to finance the actual, the newest property and be our personal guarantor. All right, so we have thought about all of these different scenarios. Each of them, when it comes down to it, is a little bit different. However, realize this: any person with more than 4 properties is definitely going to be a very strictly watched management exception, because those files take an inordinate amount of time to underwrite. All right, they're just very, 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 very difficult to deal with. And we do care about balance loading here and making sure that people don't get overrun. So please, if you have scenarios where people maybe have 5 or 6 properties and you think it might be a good fit, it's something that we can try to get you an exception on. I cannot guarantee that you would get one. I'd still say it's probably low probability, to be honest. But advise your investors to incorporate. We will allow them to close with the corporation listed as a party to title. Okay, it can't be our borrower, but it can be a party to title, and therefore then all of the members of the corporation themselves have procured their ownership interest as being members of the corporation. All right, so Sam, Rose, that is a little bit, if you don't understand the explanation there, reach out to me separately and we'll be able to discuss at greater detail. All right, let's see, our next question. Qualifications for this type of loan. Here's the most beautiful thing. If you've ever been on any of our HomeStyle conversations in the past, HomeStyle loans are qualified at the exact same credit criteria as regular Fannie Mae loans. So if you've ever gotten qualifications for a Fannie Mae 30-year fixed, it's exactly the same. We only do them as DU approved eligible loans. You need to have a minimum FICO score of 620, because we cannot do any manual underwrites on Fannie Mae loans. And we will accept income and assets based on the levels imposed by DU itself. All right, so it's basically going to go by DU eligibility criteria. All right, Rose asked another great question. Does the appraisal have to be enough to cover the cost of the repairs? The actual appraisal value definitely needs to make sense because Fannie Mae will not do these loans upside down, period. They just will not. In fact, if your appraisal value comes back at less than what the property is, less than what the actual expense on the property, so if our total cost is higher than the appraisal value, Fannie Mae will cut your maximum loan amount to essentially being that 75 or 85% of the lesser of those two values. So if it comes back that your appraisal value is less than your cost, and absolutely they will restrict you down to 85 or 75% of the appraised value. So it's tantamount important that your investors not over improve. Now, with saying that, realize that investors tend to be a lot more strategic with their investments and with the renovation. All right, they're not typically the ones guilty of over improving properties because they have zero intention of living in them. Right, so please keep that in mind. But Rose, great question. All right, let's see. Our next question. Are there any prepayment penalties? Absolutely not. Kevin, there are no prepayment penalties. Is there a contractor vetting process? Absolutely. The contractor vetting process is exactly the same as our standard Fannie Mae HomeStyle, which this loan is. This loan is just like every single other Fannie Mae HomeStyle loan we've ever done. So we do vet the contractors. They need to have the state minimum of licensing and insurance. So depending upon your state, you may be in a GC state where you need to have a GC's license to include to ever pull permits, or you could have a situation where you do not necessarily need the GC's license, but you would only need them for the case of specialty trades, which would be HVAC, plumbing, and electrical. All right, so you're going to have to be sufficiently licensed by state minimums. You're also going to need to have a $1 million general liability policy, but all contractor vetting is done on our side. Right, so we are going to take care of that. We would never leave that information in the hands of the broker. We don't, it's not that we don't trust you. It's just that you more than likely don't have the resources to research all of the actual requirements in all of 50 states. But we already do. So we definitely take care of that for you. All right, our next question, let's see. The next question is from Oren, and Oren asked if I could elaborate more on the predictive tool. That simply is the appraisal, because the appraisal is giving you a key answer that the investor always wants to know, but it's giving it to them at the very beginning of the loan process, which is huge. What will this property, what's my target resale price? Has the work done justified my resale price? And the appraisal will absolutely, positively give them great confirmation as to whether they are on track or not. All right, so that is basically the predictive tool. All right, Kevin, that's the question. Who signs off on each phase of the rehab? That is going to be the consultant hired. All right, so that managed process is managed because inside of our HomeStyle process, when we have large jobs, anything over $15,000, we use the very same 203K consultants that we normally use for our 203K loans and also for our owner-occupied borrowers. So that's going to be the same person making all of the personal, point-to-point inspections throughout the rehab process. All right, so that is the answer to that particular question. We could only take a few more, and you guys have so many great questions, and I'm running out of time because we have another scheduled webinar in just a few minutes. So I'm going to answer a couple of more of the questions, and then after that, we're going to have to basically make a fact style document, which we will have to also accompany all of the slide presentations that we were going to have to send out from all of you that were in attendance today. Great questions, guys. I really do appreciate them. Let's try to tack on as many as we can before I have to absolutely, get out of the call so we can make way for the next. Kevin, that's a great question. Is landscaping allowed to be financed on a HomeStyle loan? Absolutely. We will definitely be able to do financing on landscaping. We will definitely be able to do that. Our next question is from Brett. During construction, what is the borrower's monthly payment based on? The monthly payment is going to be based on the total amount of the loan note. In the example that we used, they have a $150,000 loan amount. So it's going to be the interest, and then the payment's broken up. More than likely, they'll finance it a 30-year, and that 30-year payment is going to be based off of obviously the length of time it was amortized over, and the interest rate. But that's it. $150,000 loan, very simple. It's very easy, and not that difficult for an investor to deal with. Let's see. Our next question: what are instances where 85% works well Do you find it's often tricky to get to 85%? That's our question from Janelle. That is a very good question. Actually, I've seen success with it recently, whereas I hadn't seen success with it in quite a few months. And that is basically due to pricing. Since pricing and rates have gone up and we have higher rates available, the instances of it working has actually began to increase because we do have higher rates available in our RFC pricing over our higher rates is where we're finding that little bit of success. So I can't give you a rhyme or reason. There's no formula for it right now, but what's making it more feasible now at the moment is that rates went up and that now we have higher rates available, and our ability to get to the higher rates has been eased because of the overall rate environment. So that's actually been a benefit, so go figure, raising rates, that's what actually has made it work. Let's see, our next question is 222. I have to stop it at 225. Is the loan available to someone who is a current owner and wants to refi while in the middle of a major renovation and needs money to finish? Now, if the current owner of the property is, has been working on it and is stalled because they ran out of money, we would be able to pick those projects up. They are very much limited to a case by case basis. There's no way to apply one, paintbrush to say that the scenarios work one way. We would have to take a definite look at the particulars of each individual scenario because the devil's always in the details. So to answer your question, Nancy, in general, yes, but we would have to look at the particulars of that case. If you do have a scenario that meets this, definitely message me separately so that we could talk about it, because if it's at all possible to do, we want to make sure that we completely and totally outline how it will work so that this way you don't spin your wheel. All right, that's hugely, hugely, hugely important. All right, we have 2 more minutes. Let's see if I can take on at least one more. What is the maximum loan amount? Maximum loan amount is going to be either the conforming limit or the high balance limit. So if you're in a high balance county, you're going to go by high balance. If you are not, the normal conforming limit, which I believe was raised to 453,100 this year. I could be wrong. Let's see. One more. We can do one more. Can we count the future rent in the debt ratio calculation? Mike Burkett, great question to end this off of. The long and short answer, honestly, is yes. All right, we definitely have a means and a measure of being able to calculate and factor in future rent if they are planning on holding the property for the course of for rent after the fact. All right. Now, obviously, if the loan file does not present the scenario where the borrower is planning on renting the property at all, I don't think we would be able to do it. All right. But if it looks like the intention is to hold the property as a rental, then absolutely we would. All right, you're going to go by that market rent analysis inside of the appraisal. We're going to factor that at 70%. Also, you're going to have to go through the process of showing that they do have the intention of renting it. All right, in our normal Fannie Mae guidelines, the requirements to show the intent to rent when they don't have a history of doing so, those guidelines can be a little bit restrictive. However, we will do our best to try to work with you to make it work where it does seem feasible. All right, but in general, I want you to realize that is something that is probably going to be a little bit difficult to prove considering the high number of instances where people sell these properties off relatively quickly. All right, so now it is 2:25 p.m. We have our next webinar starting in literally 5 minutes, so I have to let this audience go so that the next presenter is ready to present and they have their chance, just as I did, to kind of get in here and get settled and get ready. I thank each and every one of you for sticking here with me throughout the presentation, through the Q&A process. Really appreciate your business. Also, I look forward to working with you in crafting scenario questions and maybe even doing one-on-one webinar sessions for your own group and for your own company in the future. Thank you so much. This is Damon Richardson signing off here on behalf of REMN Wholesale. I thank you all for spending your Thursday afternoon with me.